So if you are one of the many Canadians who have a mortgage coming up for renewal in the next year or so, how is yesterday's Bank of Canada rate cut going to affect you? The bank made its third consecutive rate cut yesterday. The key interest rate is now down to 4.25%. But a lot of experts are saying that the real estate market probably won't feel the effects of this cut right away. It is true that the cut is generally good news for homeowners, for prospective buyers, but it will take significantly more reductions for the housing system as a whole to pick up a bit of steam, especially when you're looking at the big urban cities like Vancouver and Toronto. Now, mortgage expert Victor Tran, he's from rates.ca. He doesn't feel that the move will have any huge effect immediately. He says, mortgage rates have not come down nearly fast enough to stimulate much activity in the housing market. It's just not affordable for people. He says that with interest rates still relatively high, the math just doesn't make sense for a lot of would-be home buyers. Now, if you have a variable rate mortgage, this cut will offer some immediate relief. The prime rate is expected to drop from 6.7% down to 6.45%. So if it's variable rate, that'll have an immediate effect. It will lower rates for you Canadians who have variable rate loans, including in this home equity lines of credit, HELOCs, unsecured credit lines. But for those who are hoping to qualify for a fixed rate mortgage, you probably won't see much difference in the short term. On that note, Clay Jarvis, he's from NerdWallet Canada. He says, today's cut might get home buyers more excited about variable rate mortgages, but will they be able to qualify for them? Variables are still well above 5%, so getting past the stress test and nailing down an affordable mortgage payment could require a larger down payment than most buyers have access to. So mortgage experts generally agree that we're going to need to see further rate cuts before there's any material boost to housing activity. Given that most people expect the Bank of Canada to continue cutting rates in the coming months, the 75 base point reduction that we've seen so far since June, that could start to incentivize a few buyers, but a lot are probably also going to wait for additional cuts before they make any moves. Is Air Canada about to face a massive strike, or will they be able to avert that? The company has proposed a 30% pay raise for its pilots over the next 3 years, and this is the effort to sort of prevent a strike that's looming right now. According to insiders, the offer includes a minimum 20% upfront increase, and that's followed then by annual raises. Pilots with less experience, they could see even higher boosts that could result in senior captains earning more than $100,000 or more during the contract period. Now, by most accounts, what you're hearing out there, the negotiations with the Airline Pilots Association are still pretty tense. Talks have been going on now for over a year, and union head Charlene Hudy noted that discussions had completely stalled as of last week. Pilots have said that they are prepared to go on strike as soon as mid-September if they aren't able to reach an agreement. Now, Hudy also highlighted that a lot of entry-level pilots are struggling financially. She says that about 25% of them hold a second job. She says 1/4 of our pilots have a second job, with almost 80% of those needing the job out of necessity. She says we are trying to change that. When you compare Air Canada pilots to their U.S. counterparts, they are dramatically underpaid there, and ALPA's goal here is to close the wage gap. U.S. airlines have recently offered their pilots substantial raises. An example that they cite is United Airlines. The pilots there secured a 40% pay raise over 4 years. And just last year, WestJet pilots, representing Canada's second largest airline, they received a 24% raise over 4 years. Just recently, Harvest ETFs, they launched their high income shares ETF. Think of companies like Amazon, Microsoft, Eli Lilly, NVIDIA. These are some of the largest and most widely held stocks on the market. Well, the Harvest High Income Shares, this allows you to access these core U.S. companies, and they overlay that with their established active covered call strategy. The aim here, simple, is to deliver higher income every month. Some of the highlights of the fund are stocks that you know: Amazon, Microsoft, NVIDIA, Eli Lilly. These companies offer long-term potential growth. They participate in leading businesses with strong growth prospects. You can enjoy an attractive tax-efficient cash distribution every month, supported by the company's covered call program. Some of the key benefits: they are a Canadian trust unit structure, so they offer tax-efficient income in either Canadian dollars or US dollars, depending what's best for you. They also have an enhanced series available, which has 25% leverage. Now, you can learn more if you visit harvestetfs.com to see how they can assist you in achieving your financial goals. More signs that the U.S. job market might be in trouble. The latest numbers that came out yesterday, job openings in the U.S. dropped to 7.67 million in July. That marks now the lowest level since January of 2021. And this was a big drop from the 237,000 from the previous month. Economists had expected around 8.1 million openings. So this drop is certainly more than anticipated. Nick Bunker, he's the head of economic research at Indeed Hiring, and he says the labor market is no longer cooling down to its pre-pandemic level. It's dropped past it. While the number of job openings fell, layoffs rose to 1.76 million in July. That's an increase of 202,000. Now, at the same time, hiring actually increased by 273,000. So that pushes the hiring rate up to 3.5%, which is slightly better than in June. Now, certain sectors, and they cited here private education and health services, they saw the sharpest declines, job openings falling by 196,000. There's no doubt here that these numbers are pointing to a slowing economy. Now, Krishna Guha from Evercore ISI is remaining positive. He says the still low levels of layoffs and tick up in hires suggest the labor market is not cracking, but demand for workers continues to soften relative to the supply of workers, and a forward perspective suggests this is likely to continue under restrictive policy. So this latest report, it is showing a softening labor market. It's not showing one in a rapid decline though. So it's just sort of one of those pieces of the puzzle that the Fed is going to have to factor in when it discusses potential rate cuts at their next meeting. Shares of U.S. Steel were down by more than 17% this morning following reports that the White House is going to act to block the company's $14.9 billion sale to Japan's Nippon Steel. And this intervention is part of this growing protectionism sentiment that we're seeing in the U.S., where politicians now from both of the major parties are voicing opposition to foreign ownership of such critical infrastructure. Vice President Kamala Harris, she said at a campaign event, U.S. Steel should remain American-owned and American-operated. We're also seeing former President Trump oppose the deal, and this is one of those rare alignments of the bipartisan opposition against this transaction. Now, U.S. Steel CEO David Burritt, he says that if the sale is blocked, the company may have to shut down some of its plants and certainly move its headquarters out of Pittsburgh. He stressed here that the deal is vital for keeping U.S. Steel competitive and for protecting jobs in the face of aging infrastructure. He says that the transaction is crucial for keeping U.S. Steel's older plants competitive and for maintaining jobs. Now, in the face of this political pushback, U.S. Steel is insisting that the deal doesn't pose a threat to national security. A company spokesperson noted, "We continue to stand by the fact that there are no national security issues associated with this transaction, as Japan is one of our most staunch allies." He added that the company will explore all legal options to ensure that the deal does complete. Now, for their part, Nippon Steel, they're also defending this acquisition. They're stating that it would actually boost the U.S. steel industry and benefit national security. U.S. Steel has 20 million metric tons of capacity. If you combine that with Nippon's 66 million, no doubt this combined company would have a massive global presence. Don't forget, we have our Pulse newsletter that comes out every weekend. You can subscribe for that here. I will put a link in the description of this video. As always, thanks so much for watching. We'll see you in the next video.